There are many different types of bridge loans. Today, we will be talking about owner-occupied bridge loans, its pros and cons, and going to some case studies to illustrate the benefits and the pitfalls of owner-occupied bridge loans. By the end of the video, we will have saved you hours, if not days, of research and potentially hundreds of thousands of dollars in capital gains taxes. And potentially we will have saved you from very costly mistakes. Let's dive right in. So what is an owner-occupied bridge loan? This is a special loan with a federal exemption on some regulations. An owner-occupied bridge loan lets you buy a new home first before selling your old home. Buy first and then sell within 1 year. One unique feature about this bridge loan is that no debt-to-income ratio calculation is required. So very often, these loans are based on the equities of your existing home and your new home. And the law does not allow prepayment penalty on these owner-occupied bridge loans. So this makes it helpful for homeowners that cannot qualify to carry two mortgages at the same time, or for retirees on limited income, but who are looking to downsize from their much appreciated old home and move closer to their family on a smaller home. Okay, so what are the benefits of owner-occupied bridge loan to homeowners? With, as I mentioned before, bridge loans are often based on equity of the old home and the new home. We can do a pre-approval upfront, and without pre-approval, you can make a non-contingent offer, which is viewed as good as cash for sellers and real estate agents. So that means that you don't need financing contingency and you don't need a contingency to sell your existing home. That makes it more compelling to the seller and the seller's agent. And very often, especially for homeowners that are downsizing or or just upsizing slightly, often there's enough equity that no down payment would be needed for the entire purchase. And because you're moving into your new home first, you're only moving once, not twice. And once you move into your new home, you can more easily prep and stage your old home to sell for top dollar. By using the bridge loan, you can potentially save a lot of capital gains taxes for the short-term use of the funds. So let's dive a little deeper into this potential benefit in capital gains taxes savings. Let's look at this one scenario where a couple owns a $3 million home and they want to downsize to a $2 million home closer to family. They also have a $3 million stock portfolio up from their original $500,000 cost basis, their original purchase price. To buy this $2 million home without using a loan, they would have to sell $2.8 million of stocks and pay about $810,000 in capital gains taxes to get $2 million of quote unquote all cash. And they could potentially do this with their own money, but that's very expensive. Now let's look at the bridge loan cost. Let's say that they're able to buy the new home, sell the old home, and pay off the bridge loan all within 3 months. Their interest cost for the 3 months would be about $50,000, assuming 10% interest. And their loan origination fee, let's use a 2% example, would be $40,000. So the bridge loan cost for the duration of the loan, 3 months, will be about $90,000. And that leaves their stock portfolio intact so that it can continue to appreciate for them. So if you were in their shoes, would you rather pay $90,000 using a bridge loan or $810,000 to pay taxes to Uncle Sam and to the state of California? This is why financially strong, financially savvy clients often look at bridge loans as a strategic solution, and they use it to buy a home as it comes up and it checks all of their requirements. They're opportunistic and they're strategic. And very often we actually get referrals from their financial advisors to do a bridge loan like this rather than paying an $810,000 in capital gains taxes. So now let's look at two actual case studies, client success stories of these bridge loans. Earlier this year, we had a newly retired couple who live in Mountain View. They came to us because they saw a home lingering on the market in San Francisco near where their daughter lives. The seller had already removed the staging and took it off the market for the holidays. And they plan to put it back on the market at the end of January, restaged, rephotographed, all of that. So our client's realtor knew that to get their below asking offer accepted, it needed to be a strong cash-like offer with quick closing and no contingency to sell their old home. So we approved the couple for a bridge loan for 100% of the purchase price. And they bought their forever home near their daughter at $225,000 below asking. They moved into their new home the day after they closed escrow, and they sold their Mountain View home 2.5 months later for $600,000 above their listing price because it was vacant and refreshed and staged. It was a win-win all around. Now let's look at a different case study. In this case, the husband and wife filed divorce and they are separating their assets. The wife decided to move in and buy a house with her mother in a nearby city. So we gave them a bridge loan that's secured by the couple's old home and then the mother and daughter's new home. And the bridge loan only lasted 3 weeks. So they moved into their mother and daughter's new home, and then they sold the husband and wife's old home, paid down the bridge loan, and then we helped the mother and daughter refinance to a 30-year fixed rate loan and set them up so that they don't have to worry about mortgage payments in the future, and the assets were successfully separated. So this, again, was a win-win all around. Let's actually answer some frequently asked questions about bridge loans. So the first question is, why don't banks or Rocket Mortgage offer bridge loans? Well, with the cost of loan underwriting and loan origination, all the marketing and all the overhead, it actually takes banks 6 months or more, potentially close to a year, to recover the cost of a new loan. And at the end of the day, banks and mortgage companies, they make money on the long-term residual income from the interest payments. So they don't offer bridge loans because these bridge loans often only last 3 or 4 months, and sometimes as short as 2 or 3 weeks. And in general, it's only the private lenders that offer these owner-occupied bridge loans. Question number 2, do I need to pay off the existing first mortgage or the HELOC on my old home? I have really low interest rate on the first mortgage. And the answer is no. Maybe you do not need to pay off those existing loans, assuming you are current on those loans, no default, no issues, and you have enough equity. So in some cases, if you have a line of credit, but you have not drawn against the entire line of credit, we will ask you to freeze the line of credit first before we do our bridge loan. And in that case, we would be actually the third mortgage on the old home and then the first mortgage on the new home. So yes, it is very possible for you to keep your existing first mortgage and HELOC on your old home as part of this bridge. And then question number 3, do I need to make monthly payments during the transition? This is negotiable. If you want to defer the monthly payments until you sell your old home, lenders may charge a higher interest rate or slightly higher loan origination fee. But keep in mind, though, if you work with your realtors very closely and you get everything ready before you start the bridge loan, it is very possible that your bridge loan will only last, let's say, 2 or 3 months. And you actually may not need to make any payments out of pocket at that time because the lender will collect some upfront interest at the time of your purchase, and then they will collect some interest when you sell your old home. So it is very possible that you won't need to defer any interest payments for this bridge loan, and we are happy to do that calculation for you. So we've talked about the benefits of owner-occupied bridge loans, and we shared with you 2 success stories with our clients on the benefits of using a bridge loan. But it's not right for everyone. We will go into the details of when not to use a bridge loan shortly. Before that, I want to share with you a little bit about Abundance and what we do. We are an independent mortgage broker and private lender. We work with around 30 different wholesale lenders on these residential loans, which is very helpful if you have special financial circumstances. For example, you have a new job, you have a career change, you're self-employed, or you're retired. Because we shop for you, we save you a lot of time, and we will eliminate options that don't make sense for you and give you the options from multiple lenders that may be best suited for your need. And we will use our years of experience as homeowners, investors, borrowers, and mortgage advisors to help you make the right long-term solution. And we invite you to follow us on our YouTube channel as we provide more content, more meaningful content that will help you make informed mortgage and investment decisions. Now we will look at 3 case studies where bridge loans may not be the appropriate solution. So case study number 3, this client actually wants to move to a bigger house, and at the end of the day, they will need a bigger loan, bigger conventional loan. Their old home is worth $1 million, and they have a $400,000 loan balance. They want to buy a new home of $2 million. Yes, we are able to lend them the purchase amount for this new home using an owner-occupied bridge loan. That's actually hitting the max of 80% loan to value. But the challenge is once they sell their old home, pay down the bridge loan, they still need to qualify for a $1.4 million loan. And if they don't qualify, that would put them in a bad financial situation, having to pay the higher interest rate bridge loan for a longer period of time. So what are the possible solutions? Well, first of all, we always qualify the buyer for the post-bridge refinancing before we approve the bridge loan. This is because we want to make sure that we always set up our clients for financial success. We don't want them to be surprised. So we will do that qualification. And then we can potentially use both their current income, for example, their paychecks or their income from their business, and we can use their retirement or brokerage accounts balance to help them qualify for the $1.4 million home loan on their new home. And there are in that type of loan, you don't actually need to draw from your retirement account or draw from your brokerage accounts to qualify for the loan. You just need to have enough available balance. So that's one way of qualifying their loan qualification after they have sold their old home. And then another option is for the client to get a cosigner that's financially strong to help them qualify for this refinancing of the new home after they have sold their old home. And the cosigner can stay on the loan until the primary owner's income situation improves or until the interest rate drops, where the couple by themselves can qualify for this $1.4 million loan without the cosigner, and then we can help them refinance again. So this is why we always want to make sure that we qualify the buyer before for the post-bridge refinancing before we approve them for the bridge loan. Case study number 4. This is where the owner-occupied bridge loan, even though it is, it can be easily done, it is not the right solution for the client. In this case here, the client wants to downsize and buy a newer home and cash out. They want to buy the newer home in the same neighborhood. So their current home is worth $4 million. It's up from the $800,000 at the time of their purchase. They want to buy in the same neighborhood but newer home for $3.2 million. in their mind, they would cash out $500,000 or more from this move. But if you actually look at the math, after the 5% sales cost, they would still have around $3 million of capital gains from their old home, $3 million of capital gains. And then they take their $500,000 homeowners tax exemption for the primary residence. They would still need to pay $875,000 in state and federal income capital gains taxes from their old home. Okay, so this is before they even buy a new home, and the net of $2.15 million from the old home is not enough for them to buy the new home without getting a mortgage. So this is actually not a good solution for that client because of the capital gains taxes. If their goal is to actually cash out, it would be better for them to actually get to refinance or to get a line of credit from their home. And there are other strategies as well, but for the purpose of this bridge loan presentation, we want to show you that bridge loan, while it's a great solution, yes, we could help them buy this new home, it is not the right solution for this client. Finally, let's go into case study number 5. You should seriously consider how long you need the bridge loan before you start embark on this journey to buy first before you sell. In this case here, the client wants to buy a new home, a new detached home, and sell their existing condo. As many of you have heard, back in 2015, there was a building collapse, a balcony collapse in Berkeley that killed 6 and injured 9 students. You probably also have heard about the 12-story beachfront condo that collapsed in Florida back in 2021 that killed 98 people. These balcony collapses, structural issues, led to new regulations making it more difficult for home buyers, to get a loan in communities where there are known or suspected structural issues. And because they cannot get a loan, these new home buyers cannot get a loan in these communities, it is very difficult for these condo owners in these communities to sell. In such a case, a bridge loan is a bad idea because there's no clear and quick exit from the bridge loan, and you don't want to be forced to do a distress sale on yourself because your bridge loan is coming up to its 1-year anniversary. It may take months or years to resolve a structural issue, and in cases like this, we do not recommend a bridge loan. So finally, is a bridge loan the right solution for you? Well, it really depends. And we advise that you talk with your tax advisor about the capital gains taxes from selling your old home, and then about capital gains taxes from selling your stock or other assets. We advise that you speak with a knowledgeable real estate agent about any potential obstacles to selling your old home quickly and for top dollar. And finally, we advise that before you get a bridge loan, get pre-approved with us so that we can help you understand your financials during the 3 or 4 months of your bridge loan, and then your qualifications for a post-sale refinance after you sell your existing home. I hope all of this makes sense to you, and we are very happy to answer any questions you have about bridge loans or any other types of loan, residential or commercial loans. Please feel free to reach out to us and follow us on YouTube for more informative, educational mortgage and real estate information. Thank you.